All right, let's get right into it. What we're talking about today isn't just another environmental policy. No, this is a core financial survival strategy for what's coming next, because in the world of carbon emissions, the whole game is about to change, fundamentally. I want you to remember one year, 2026. This isn't just another date on the calendar, it's a pivotal, irreversible turning point for South Korea's carbon market. You see, the old ways of managing carbon costs, they're officially over. A new era of financial risk and, yeah, opportunity is beginning. So, what is this new reality exactly? Well, it's all being driven by the Fourth Emissions Trading Scheme, or ETS period. And the bottom line is pretty simple. You know that rulebook companies have been following for years? Yeah, you can pretty much throw that out the window. These changes are creating a perfect storm. From 2026 to 2030, the amount of carbon credits companies are forced to buy is going to absolutely skyrocket. And at the same time, new rules are coming in to manage supply and price, which just adds more complexity. So what's the big takeaway? The old strategy of just passively buying credits when you need them, that's not going to work anymore. The market is now demanding proactive financial planning, something we call hedging, which is all about protecting yourself against future price shocks. Okay, so how does this all translate into actual money? Or in this case, won. This isn't some abstract change in regulations. We are talking about a massive, very specific cost that's about to slam the bottom line of companies. And it could have ripple effects on everything from national competitiveness to the prices you pay for things. And this chart just perfectly shows the scale of the problem, especially for the power sector. In 2026, they'll need to buy about 15% of their carbon credits. Now, fast forward just 4 years, and that number explodes to 50%. Half of all their required credits will have to be bought on the open market, leaving them completely exposed to whatever the price happens to be. And here it is, the grand total, 27 trillion won. That is the estimated cost burden that the industry is facing over these next 5 years alone. This isn't just an environmental line item in a budget anymore. This is now a core factor in a company's financial health and its very stability. So when you're staring down a number that big, you have to ask, how can companies protect themselves? Well, the solution is really all about a shift in perspective, from simply buying a commodity to making a strategic investment. It's about trading for the future today. And this is the key idea right here: forward carbon offset trading. The best way to think of it is as an investment-style hedge. So instead of waiting to buy credits later at some unknown and likely much higher price, a company provides the upfront funding to a carbon reduction project. In return for that early investment, they get the future credits from that project at a price that's locked in right now. The process itself is really straightforward. First, a company gives initial funding to a climate tech partner. Then, that partner uses the money to actually build and run a project that reduces carbon. And finally, the carbon credits that are generated, they're called Korean Offset Credits, or KOCs, they're delivered straight to the company that provided the funding. It's that simple. You've secured your supply for the future. You know, what makes this strategy so powerful is that it's incredibly flexible. This isn't a one-size-fits-all solution. Companies can actually choose the pricing model that makes the most sense for their own risk tolerance and their financial strategy. There are basically 3 main models you can choose from. A fixed price is just what it sounds like. You lock in a price and you completely eliminate any future risk. You know exactly what you'll pay. Then there's a floating model, which lets you take advantage if the market price drops, since you get your credits at a discount to the average. And finally, you've got a hybrid or collar model, which kind of gives you the best of both worlds. It sets a price floor and a ceiling, so you're protected from those extreme highs and lows. So why is this all so urgent? Why talk about this now? Well, because we are in a truly unique window of opportunity. There's this massive gap between what carbon costs today and where every single expert projection says it's going. Just look at this comparison. Today, a ton of carbon costs around 10,000 won. By 2030, that price is forecast to be more than 50,000 won. That's a 5-fold increase. Acting now means you're locking in future assets at a tiny fraction of their predicted cost. The price of waiting around is just enormous. And this isn't just a wild guess. This forecast comes from a 2025 report by the research firm Namu NR. You look at the market dynamics, demand is going up, supply is getting tighter, and all signs point in one direction: up. But this whole strategy is about more than just smart financial management. It's structured in a way that actually creates a powerful, positive impact, perfectly aligning a company's goals with the nation's climate objectives. This approach really gives you a three-tiered advantage. First, you optimize your costs by locking in today's low prices. Second, you create financial stability with budgets that are actually predictable. And third, and this is a big one, you get genuine ESG impact. You're not just buying an offset on paper, you are funding real-world carbon reduction projects and helping innovative smaller businesses that are building our green future. And that's what makes this a true win-win model. The large companies get to manage their financial risk, the innovative small and medium-sized businesses get the funding they desperately need to grow, and the nation as a whole makes real, tangible progress toward its climate goals. It's a solution where everyone comes out ahead. Which brings us to a final, really crucial question. We often think of finance and sustainability as two separate things, sometimes even goals that are in conflict. But what if they're actually two sides of the same coin? Because strategies like this one suggest that maybe, just maybe, our cleverest financial tools are also our most powerful accelerators on the path to a truly sustainable future.